Good morning, happy Friday, and welcome to Sunrise Small Talk, episode number 75. I'm going to try something a little bit different. In this episode, we're going to talk about some of the recent trades that were made at the end of September and talk about the rationale and the reasoning behind them that is given by Carson's investment committee. Whatever portfolios you're in, you will get an email for the trade rationale whenever something happens, and I just thought there was a couple neat ones and I wanted to highlight them. Also, before I dive into episode number 75, I can't hear the number 75 without thinking about one of my favorite workout routines, lifestyle programs, whatever you want to call it, 75 Hard. I did an episode about this a few years ago. I want to say I've done it 3 times. So before we dive into the trades and the rationale, I just want to quickly tell you that number one, link to the YouTube page on the Sunrise Small Talk about 75 Hard is in the email. Also, here's what 75 Hard is. Awesome program. Anyone can do it. Challenging. You'll learn a lot about yourself. It's 7 things you have to do every day. 2 workouts. One has to be outdoors. They have to be 45 minutes long. You can go for a walk outside if you want, whatever it is. But 2 workouts, one inside, one outside. They can both be outside. One of them has to be outside. You have to drink a gallon of water. You have to take a progress picture. You have to follow a diet and have no cheat meals or alcohol. And you have to read 10 pages of a book, not an ebook, an actual book. I've done this thing 3 times, done 50 days of it a few times, but awesome thing to do. I think anyone should give it a try. Let's dive into the episode. All right, the first trade I want to talk about is in our QBI strategy. I will say the disclaimer that the best source of information is going to be your own accounts, custodians at Schwab or Fidelity, and your own personal statements. This is just general information. You may own some of these funds and have experienced these trades on your end. You may not have. There's your 75 Hard over there. I'm going to leave that up. 1 workout, 45 minutes. 1 workout, 45 minutes outside. Gallon of water, progress picture, 10 pages of reading, nonfiction, physical book. Follow a diet, no alcohol or cheat meals. Okay, so trade number 1, equity. I think equity is more exciting than bonds. We're going to talk a little bit about bonds next, but equity trade. We exited out of public storage and entered into WP carry. Reason is just some of the weaknesses that were shown on the public storage side of things. Strength in WP carry, which is just a big publicly traded REIT, a little more diversified as opposed to being strictly in storage. I like storage. I think storage is great. However, just based on the metrics of the way the stock has been trading, that is the reason and the rationale behind this trade. The public storage is pretty much flat on the year. WP carry, that REIT is up 20% or so. Again, fact check me on that, but rough numbers. On the bond side of things, excuse me, just sort of some general knowledge. I don't want to get too deep into the weeds here because bond trading is very tricky and confusing, but a couple concepts that I think are important. Number 1, duration. Duration is not just a measure of time, but also a measure of multiple components, something that you actually have to calculate by hand when you do the CFP, which is silly because I'm never going to use that in practice. But we like to keep the portfolio, the main income portfolio at Carson, in a duration range of 2 to 2.5. That's very, very low on the duration. Think of duration as overall risk and sensitivity to interest rates. So we like to keep that around 2 to 2.5. It had been recently shifting more towards the upper end of that range. So how do we combat that and get it back to where we want it to be? Well, number 1, you reduce exposure to high yield. High yield is considered risky, and a lot of times that's a minus sign there. A lot of times when you enter into high yield positions, they have a longer timeline and the companies don't have as high of a credit rating. So shifting out of high yield and going into what we call investment grade corporates. In addition to that, you're sort of going to pick ones that have a shorter timeline, less sensitive to interest rates and other economic situations. So reducing high yield, increasing investment corporate grade bonds, that helps get our duration back to where the investment committee prefers it to be. I added PIMCO up here. We use a lot of PIMCO. If you're in the fixed income or bond allocations, you'll see the PIMCO if you look at your Fidelity or Schwab account statement or dive into your portal. You'll see PIMCO listed a lot. They really have been the leader in the bond market for decades and decades, since way before I started in the industry. I remember college at CSU back 2004, 2005. In my fixed income class, we always talked about PIMCO, PIMCO, PIMCO. So you will see quite a bit of PIMCO in there. The PIMCO Income Fund is kind of an anchor and a staple of a lot of the fixed income portfolios that we have that you may or may not be invested in. The PIMCO Income Fund is really just somewhat of an unconstrained, when I say unconstrained fund, that just means that it can really invest in any piece of fixed income or bond markets that it would like to, wherever the managers want to invest the money. An example of that, so that could be corporates, treasuries, municipals, foreign bonds, whatever it may be, but one example of that, and one thing that the investment committee likes right now, is agency MBSs. That sounds complicated, but one of the moves they have made, not only in some of the PIMCO funds, but also the investment committee has been seeking out some other ETFs inside the fixed income portfolios that have a little bit of a heavier weighting into agency MBSs. Reason for that is, well, what is an agency MBS? That's Fannie Mae, Freddie Mac, Ginnie Mae. It's a pool of mortgages that is backed by one of those three branches of the government. Why is that important? Well, because the government can print money, so really that reduces risk, because when the agency that owns those mortgages can simply print money if they need to, reduces the risk. That's kind of an extreme example, an example that hopefully realistically would never happen, but by the fact that those bonds are owned by one of those three branches of government, Fannie Mae, Freddie Mac, Ginnie Mae, does just simply by the nature of that reduce some of the risk in the portfolio. So that's a little bit of a bond lesson there. Again, some of the things we're doing to reduce duration, decreasing high yields, increase to the investment corporate grades, and then increase to agency MBS. MBS, you've heard that term before. That stands for mortgage-backed securities. So you've heard that term probably 100 times. If you didn't know what it was, there you go. AMBS, agency mortgage-backed securities. Mortgage-backed meaning they are backed by one of those branches of government. Fannie, Freddie, Ginnie. Okay, hope you all do that, and hope that made some sense. And I tried to keep that kind of at a elementary-ish level. If you want me to go into more detail next time, let me know. If that was too much detail, let me know. If you thought that was just kind of boring and don't care and you want to let the investment committee do their thing and not pay attention, that is great as well. Let me know. Appreciate feedback on this. Feel free to share with others, and have a great weekend.